Good morning. Welcome, everybody. My name is Zach Hurst with the Trust Company of Tennessee. You'll see on screen with me co-workers of mine, Chad Scholart and Adam Davies. For those of you who are not clients or aren't familiar with us, the Trust Company of Tennessee is a financial planning firm. We are spread across East Tennessee and hopefully work with many of you on this call with retirement plan services. And today we are coming to you with a topic that does relate to retirement plan services, but also to all of us as individuals. It's all the noise we're hearing out there in DC and then throughout about potential tax changes, potential increases in taxes. And so we wanted to hit on a current topic and really cover this on a broad level in terms of how it's going to impact us, the individuals, and how it's going to impact us, the 401k plan providers, and you, the 401k plan sponsors. Before we get there, guys, I need to do a couple of housekeeping items here. Number one is we are offering 1 hour CE credit for SHRM, HRCI, and CPE. There are some extra little steps I've got to do here for CPE, so let me pull my sheet out. For those that are looking for CPE credit, quick reminder on these, you do need to answer all 3 live poll questions that we're going to launch beginning soon, and that's for the entire audience to participate in. The second is you will need to stay on for at least 50 minutes. We promise to not keep you much past 50 minutes. And the last thing is you will need to fill out the evaluation form that we provide at the end of this webinar. Once you do that, we will send an email out in the coming days to give you the information you need to carry on and get those credits loaded. So Chad and Adam, very briefly, Chad is our Chief Development Officer and has worked at the Trust Company for about 19 years or so, I believe, Chad. Yep. I'm making that up. I don't know if it's right or not. Okay.
You're spot on.
That's good. That's good. Chad has spent the bulk of his time working in retirement plan services. Adam Davies, Vice President, who heads up our retirement plan services. These guys are the experts on the call for plan sponsors. I'm just happy to join them and moderate and pass it along today. So again, I'm Zach Hurst. I'm out of our Chattanooga office. I'm a certified financial planner, and so I might jump in on some topics about how we can help participants within plans along these topics. Last piece, there is a questions box that you'll see on the screen. If you have any questions, please put those in as we go. I'm going to try to address those as we go. If we get caught up or if we're kind of moving along and can't get to that right then, we will save time at the end for those. So, Chad and Adam, I think we will skip our mug shots here since they're all looking at us anyway. And Adam, before I jump into this, it says where taxes are today, and we're going to get there, but also show a little bit of a history as to how we got to where we are today. And we'll be brief about this, but before we get into it, let's launch our first poll question for all audience to answer, and that's going to open in just 1 second. I believe it is open now. It is. So in what year were federal income taxes first introduced in the U.S.? Was it 1776, 1899, 1910, or 1913? Adam, I hope you know the answer to this because I honestly don't.
Well, I was just going to ask you, what's your guess?
Well, this is going to be embarrassing because I'm going to get it wrong. I don't think it's 1776. Can I just stick with that?
Process of elimination.
That's right. Yeah, do I get to phone a friend on this one? We'll give it just 1 second, let everybody get their answers in, and then we will pull the results and see what we came up with. And guys, I'm on a small screen here, so if you see results pop up before I do, just let me know. All right, and there they are. All right, I think everybody agreed with me that it was not 1776. We're right there. Adam, it looks like the bulk said 1910. Is that
That's
right?
Pretty close.
After
the correct answer is 1913.
There you go. So take us through a little bit of history here. Adam will be brief on this, but talk a little bit how taxes got started, and then we'll get to where we are today.
Yeah, so if you think about it, I mean, taxes are a pretty polarizing issue for us here in the U.S. I mean, if you think about things like the Whiskey Rebellion, the Boston Tea Party, the American Revolution, these are all events that, at least in part, started over disputes over taxes. So it's probably not a big surprise that it took our country nearly 100 years to implement the first sort of income tax, and that was implemented during the Civil War. It was very briefly implemented. It was a 3% tax on any incomes over $800, and it really wasn't until even 50 years later that the income tax system as we know it was introduced in 1913. And so that was a graduated schedule starting at 1% all the way up to a maximum rate of 7%. And so even then taxes were relatively small And since that time, it's just expanded and covered different things like state income tax, sales tax, gift taxes, Social Security. So the government has been pretty creative in finding ways to tax us, but it's definitely been a polarizing issue in our country.
Is it safe to say that what's being discussed in DC right now is not taking tax rates back to 1 to 7%?
I
think that's pretty safe to say. All right, let's go with.
I was going to say something that you all may not know about Adam, and is that he's a history buff, as you can tell a little bit by this slide, but specifically, he's a presidential history guy. Do you know offhand the presidents here, Adam, for each year? It's pop quiz, and we didn't rehearse this, so this is going to be
I could probably go through, but 1862 was Lincoln, 1913 was Wilson, 21 probably would have been Taft. I got a little cheat there with 1935 FDR, so I don't think anyone on the webinar wants to hear me guess the presidents.
Well, Chad, I don't even know why you ask, because you and I don't know who they are. We can't fact check them.
I think he's
probably right. What we can do, though, is launch poll question number 2. Might be a bit of a tricky one. And the question is, what is the highest individual income tax rate in U.S. history? Is it 39.6, 49%, 63%, or 94%? Pretty big range there, guys.
I still wish it was 7%.
Yeah, likewise. What I'm curious about, and I don't know this, and I don't know if you guys do, but in my lifetime, and about the same for you guys, about 40 years or so, I don't recall taxes as I've known them to ever be higher than that first one, but I'm sure they probably were. Adam, do you have any idea?
I don't want to spoil the surprise for our guests.
No. Okay, got it. Well, there you go, folks. I think the answer is not 39.6% based on what Adam just gave us. We did have some guess the 39.6, which is the highest rate that I remember. So I'm right there with you. And then pretty spread throughout the next 3, 94% being the lowest. Chad, talk to us about the historical tax rates and the answer to that question.
Yeah, 94% is correct. As ridiculous as that sounds, that is the correct number. And if you take a look at this chart here, back in the 44 to 45 time frame, the top marginal tax rate did hit 94%. So you can see coming out of the Depression, tax rates really started to go up. And what's interesting here is that top marginal tax rate was for income over 200,000. And if you adjust that for inflation in today's numbers, that would be about 3 million. So for income over that amount, 94% was the tax rate. So yeah, Zach, your question there about what has it been in our lifetime? I was born in '76, so it was as high as 70%, and then it's come down from there. So we're really at historically low tax rates right now. If you look back at history, and I think that's somewhat of the point of this this chart here, is that we really are at pretty low tax rates looking back.
Yeah, and this is really going to lead into one of the topics today, which is the Roth 401k. And you think about the design of a 401k, and the concept here is that we're going to be taxed higher in our working years than in retirement. I'm certainly not saying that's not true. That certainly might still be the case. But as Chad shows us this chart, we start to wonder a little bit about that concept and that theory of will it hold true? None of us know, but it is a little frightening to think that we could even be in higher tax brackets down the road. So just something to keep in mind as we go. And Adam, as we finish this little section up, I want to know what national debt has to do with taxes and what you're projecting here.
You can imagine we're having conversations with clients all the time about taxes and, where they might go. And probably one of the most common reasons I hear of why people think taxes might increase in the future is because of the national debt. And so that makes a lot of sense. I mean, you look back to World War II when taxes were, 94, 95%. And, that's when we had really high debt levels. And so it makes a lot of sense that if our national debt increases, we need to generate more revenue to pay for that debt. And so all that is, of course, to be determined by Congress, but it does seem logical that if debt is increasing, taxes should have to increase down the road as well.
Okay. Good, and let's get into what's actually being discussed right now in Congress. This is ever changing. I think we did a presentation 2 months ago on several things that aren't even in the current bill. But Adam, talk to us a little bit about what's happening in DC and what we can maybe expect in the coming weeks and months with this.
Sure. So there's been so much back and forth about what's in, what's out. So we wanted to give you the update as we know it today of what's in, what's out, knowing that it could change very quickly and very dramatically from day to day or month to month. So you see some of the things in green up here on top are the current provisions that are still in the bill. And two of these are, pretty significant. One could be the elimination of backdoor Roths. If you're not familiar with that concept, it's an IRS-approved way to make a Roth contribution once you exceed income limits. So currently, if you're married, filing jointly, and make over $208,000, you're not permitted to make a Roth contribution. But you can do a backdoor Roth by making a non-deductible IRA contribution and then converting that balance over, paying the taxes, and essentially you end up in the same result. One of the things Congress is talking about is potentially eliminating that starting next year, and then over the next 10 years, eliminating the ability to convert balances that are already in a traditional Roth IRA in a traditional IRA to a Roth IRA. So that could have some pretty significant financial planning impacts for those people that are making those backdoor Roth contributions. And then the other one that's currently still in is a cap on 401k balances. And we've never really had anything like this before. And so essentially once your 401k balance, IRAs, all of them in aggregate exceeded 10 million, you'd be required to take a special RMD to force that money out of qualified plans. So that special RMD would be 50% of any amount that's over 10 million. And then if somehow your account was able to exceed 20 million, you'd have to take 100% of the balance over 20 million. So this is something new, and you can see it would only apply to those with incomes above 450,000.
And so these changes that are previously discussed were at one point in bills you see at the bottom of the page here. I think we list those to note two things. Number one, they're not in there currently, but you got a bill right now that's Adam, stop me or correct me if I'm wrong here, that's in the House and at some point will be voted upon by the House to move to the Senate. And I don't think it's that far-fetched to think that a Senate bill might reintroduce some of these things that have been discussed but dropped. Is that fair to say, Adam?
Yeah, exactly. So in fact, when this was first introduced on September 13th, all of these provisions were originally in there. And then in October, even the two up top were taken out. Then back in November, they were reintroduced. So who knows what could happen in the House discussions, the Senate discussions. You can see even some of those that were taken out, would increase the top ordinary income back to 39.6, increase in capital gains from 20 to 25%. The top corporate tax rate has been a big discussion. Earlier this year, one of Biden's proposals was to increase that as high as 28%. You can see the House version was as high as 26.5%, and then some changes in the estate tax exemption. So I think all of these are on the table. They could be included, they could be excluded, but as we know it today, just the top two are active in discussions.
Okay. Yeah, and as we get into this and the next short section that we have, I just want to take a moment to point out to plan sponsors, some of this that we're going to talk about today relates directly to plans. Some does not, right? But anytime you bring in an advisor on your plan, that advisor is going to end up talking to your employees about probably most things besides their 401k balance. You really are providing a financial advisor to them that they may not otherwise have. So all of these are going to be important to your people. I know you know that, but it's important to get your advisors in, spend time with them, schedule virtual meetings, at least offer that up to your employees, because right now there are a lot of questions going on about this, and it'd be great for them to just have some answers as we're providing these today. So Chad, with that, tax provision scheduled to sunset in the future. This is the only part about this whole tax situation that we actually know as of right now. Chad, do you want to talk to us about this?
Yeah, so some people are of the opinion that, Congress is just going to keep fighting about this and that nothing's ever going to happen. Well, that may or may not be true. Well, even if nothing happens with the slide that Adam referred to with the new changes in tax law, the current Tax Cuts and Job Act rates and provisions will sunset in 2026. So even if nothing happens in Congress, these the current situation will change in 2026. So you can see there that individual tax brackets are going to change, not just at the top rate. That's what grabs all the headlines, is that the top rate's going to go from 37 to 39. But you can see all of these brackets underneath change as well. So it's not just going to impact people at the top. And again, this is 2026. The other portion is that the standard deduction is going to go back down to the lower rate. So currently it's at 25,100, and that's going to go back down to 13,000. And that's for a married couple filing jointly. The tax credit, the child tax credit, is going to go, currently at 3,000, or if you have a kid under age 6, it's 3,600. That's going to go back down to 1,000 per child. And then the estate tax, which Adam mentioned earlier, currently the estate tax exemption is currently at 11.7, and that will likely go down somewhere between 6 and 7 million. Those numbers are adjusted for inflation, and that number is per person. In addition to that, the estate tax goes back up from 40 to 45% in 2026. So again, even if nothing happens, even if Congress doesn't change anything between now and 2025, these changes will happen in 2026, which means higher taxes.
Yeah, so the estate tax exemption, that's a hot topic right now with a lot of people, because what's being proposed out there, at least at one point, I think it's still at least being discussed anyway, is the idea that that threshold will go from, what is it, Chad, 11.4 million per person?
11.7 currently.
11.7 million per person would come down to about 5 million per person. And so there's a lot of planning going on with people who are in that situation or finding themselves in that new situation. And I've seen a lot of relief, because some of that language has maybe died down a little bit, or there's a perception that that won't take place. But the point you're making here, Chad, is they still need to plan, because this thing's going to fall back to 6 million through the sunset anyway. So this change is coming. So there's a lot of planning still to be done by that crowd.
Yep.
And I personally really hope they keep the standard deduction, because that makes my life a lot easier. Okay, so we have plan sponsors on the call. Adam, I want to talk to them a little bit about some ideas, strategies they can pursue based on some changes we think might be taking place.
Definitely. So, if you're of the opinion that taxes are going to increase, what can you do as an employer to help your employees defer taxes, save taxes? Or sometimes the employer and the investor are one and the same. You might be the decision maker in a company, and you're trying to find ways to manage your own taxes. So what are things you can do from a plan perspective to help with those tax savings or tax deferrals? Probably the most common is implementing a 401k plan that allows employees to save up to $19,500 through either that tax deferral or on a Roth basis, in which they get tax-free growth down the road. You can then offer an employer match on top of that. That's tax deductible to the employer. That's additional money that can grow tax deferred for employees. And then the maximum that you can do within that 401k plan is, a profit sharing contribution, and you can have the employer contributions go all the way up to $58,000 when included with the employees' contributions of $19,500. So we see a lot of companies offer these variables in some form or fashion: the 401k, the match, the profit sharing. Even beyond that, there's some niche options like a cash balance plan or a non-qualified plan. And in fact, I was meeting with a company on Monday where we were talking about their cash balance plan. They're a relatively small organization, just a few employees, but the business owner is able to save $58,000 for himself within the plan, and then he's added a cash balance plan on top, where he's able to save an additional $315,000 for himself personally, and of course you have to give contributions to your employees as well. But these are really great options for him to defer his taxes into the future, when potentially, he might have lower personal income taxes. And then Chad, I know you work with some companies on non-qualified plans.
Yeah, and so on the non-qualified plan space, that we did a webinar on that last time. It's pretty complicated. I would say that if it's something that's of interest to you, reach out to us at the trust company or your advisor to see if they can help you determine if a non-qualified plan makes sense. Same with cash balance. It doesn't work for everybody, but there are cases where it can really be pretty powerful. Non-qualified plans are really just deferring income tax into the future. It's just a vehicle to do that, and it depends on how you want to structure it, but there's definitely ways you can save on taxes through a non-qualified plan. And a non-qualified plan is separate from a 401k plan. It's a whole different deal, has its own rules and regulations and things like that. But yeah, both of those can be great options.
Chad, I had a question come in here, and it kind of touched on what you just said of cash, both of these, but really cash balance plans is a question not being for everybody. Is there a certain type of company or makeup that typically works for this? The question is basically just asking, who is this right for?
Yeah, I think where we see it most often is a lot of specialty medical groups, and typically the ones who benefit most from a cash balance plan are professionals that are making, probably more than $500,000 a year, and so they're able to sock away some money in a cash balance plan. If you're an employee of that entity, you're going to get some contribution as well, similar to a profit sharing plan. But usually it makes sense when you've got, income in that level. And there's also some demographic things to consider as well. So the older you are, the older you are and the more money you make, the more a cash balance plan can make sense for you.
And I would add that typically we see these in smaller organizations. Once your organization becomes a certain size, cash balance plans are often cost prohibitive.
Yep.
And Adam, we have, obviously I think everybody's pretty familiar with the 401k employer match and profit share, and many companies thankfully do offer the match to encourage their participants to give. The profit sharing, I'm not sure if you'll know this answer or not, Adam, is there a trend one way or another with profit sharing in terms of what companies are doing across the board, either doing that or doing away with it?
That's a really great question. I'd say it's probably industry specific and even time period specific. So last year during COVID, we saw some companies cutting benefits, but then currently this year, there's a hiring squeeze out there, and a lot of people are really trying to find creative ways to attract employees. And so a profit sharing could be a really great way to do that.
Good. All right. Thanks for the questions, and thanks for getting those answered, guys. So some strategies that employees, not employers, but the employees, those that we're taking care of and the plan sponsors are taking care of, what can they pursue? Before I get to you, Adam, let's launch our third poll question. Our folks behind the curtain will get that, and here we go. True or false, to participate in a Roth 401k, you must not exceed a certain level of income. Guys, I hope we all know the answer to this question, so I won't put you on the spot, just in case.
Well, I like that there's only two choices.
That's right. Now we can use the 50-50 instead of the phone a friend. Give just a minute on that, and then going to cover a few things here, and also provide you with some things that we provide to our 401k clients and their employees, and how we talk through some of these strategies with them, because they can get pretty confusing. We live in it every day, but some people just hear about this in passing, and it's kind of tough to figure it all out unless you're sitting down with somebody. Here we go. It's a trick question, and you'll see a mix of answers here. Good job to everybody who said false on that because, and those of you who said true, you may have thought we were talking about a Roth IRA. That is the case in a Roth IRA. Adam, do you want to talk to us about the benefits of a Roth and some of the differences here?
Sure. So, Roth has definitely been something that's been trending and been gaining in popularity, and because there's plenty of great benefits that come with it. So, one of the most powerful is that tax-free growth. This is especially beneficial if you have a long time horizon, 20, 30, 40 years for that money to grow tax-free, because whenever you take it out down the road, you're not going to owe any further taxes on it. It makes planning a lot simpler. You know exactly what's going to be in your account, rather than having that traditional balance and trying to figure out, okay, is 22%, 24% of this going to go to Uncle Sam one day? Tax-free growth is great. One of the other benefits is avoiding RMDs. So if you roll your Roth 401k to a Roth IRA, you're not going to be required to take that balance out of your 401k once you hit RMD age, which currently is 72. There's some proposals that might push that back as far as 75. And if
I was just going to say RMD stands for required minimum distribution.
Thank you. Sometimes in our industry, we like to use the ABCs and letters, and we forget we speak our own language. So thank you, Chad.
Makes us feel smart.
I know beneficiaries love Roth money. They don't have to pay any taxes on it. One of the changes from the Secure Act back in December of 2019 is that you're no longer able to stretch those payments out over your life expectancy. Now, if you inherit pre-tax or traditional funds, you have to realize those taxes within 10 years. In some cases, that could push you into a higher income tax bracket. Potentially if you're in your higher income earning years, that's not going to be a great situation. Roth allows you to receive that money tax-free, no further taxes. And then this last one is kind of a neat thing in that you can actually save a little bit more. You're still limited to the same $19,500 that you can put in as an employee, but that $19,500 is after all taxes have been paid. If you were to do it on a pre-tax or traditional basis, you're putting in $19,500 that will later be taxed, 20 or 30%. So by saving on a Roth basis, you're actually able to contribute a little bit more. And so as I think about these four things, there's also the added benefit of tax diversification, and that who knows where tax rates will be in the future. They could go up, they could change in certain areas, but by having pre-tax funds like your employer contributions and then Roth funds, which you won't owe any further taxes on, you can strategically pull from those buckets to maximize your tax situation.
And just touching base again on the question itself, we think about these Roth IRAs and we think that some people aren't eligible for them, which is true. And Chad mentioned earlier, there is an income threshold for that. You also can only contribute, I believe right now, $6,000 if you're under 50, $7,000 if you're over 50 into a Roth IRA, even if you are eligible. So, those who find benefit in it, I'm certainly a big proponent of Roth. This gives everybody a chance to contribute and participate in a Roth vehicle. And because of what we talked about so far with historical tax rates and the unknown of the future tax rates, this is no longer just a play for people who are 20 and 30 years old and have this long runway. We're talking a lot of 40, 50, 60-year-olds who are thinking, well, I've still got a long runway through retirement, and does this make more sense for me? And it comes down to your personal tax situation, but the answer for a lot of them is, yeah, it probably does make some sense. So that's what, guys, correct me if I'm wrong in terms of your experiences, but those types of conversations, that Roth versus traditional, has taken up most of my discussion time with participants in terms of what they're interested in. And the other one, there is a lot of money being passed down from a generation right now to a lot of our employees out there and your employees out there. And many of them don't know this 10-year rule that Adam mentioned. And so there's a lot of strategy going on around that. This all goes back to, as advisors on plans, we spend a very small fraction of our time actually talking about the investments or questions in the plan specifically. It's much more about this. Guys, have y'all had the same experience?
Oh, definitely. I mean, a lot of our conversations with participants are what's best for your situation. Where are you in your income earning years? Are you in a higher tax bracket, lower tax bracket? What are your goals? Do you want to pass on that money tax-free to your children? And so based on those answers, that's when we'll work with them to figure out is traditional or Roth best for their situation.
I think it's important to note too, Zach, that if you work with a firm like the trust company that's able to give advice as a fiduciary to participants, that's not just about investments. It can be about whether to do Roth or pre-tax, or how to structure their beneficiary designation to make sure that they cover the right people and the right way. It's just not just about how to invest your money.
Mm-hmm. Okay.
So earlier we talked about some of the changes being discussed in Congress, and there currently isn't any discussions around changing the Roth 401k. But we did mention that potential elimination of backdoor Roths, and that is something on the table right now. So currently in 2021, backdoor Roths are still permitted. If this legislation goes through next year, that's something that could be taken off the table.
All right, and there is a question coming in now, and it says, what if you are over 60 and have most of your retirement in traditional 401k? Any way to convert to Roth with several 401ks? Chad, you want to take a stab at that one?
Yeah, sure. So a lot of plans don't allow in-plan Roth conversions, and there's some kind of quirky details about why that's the case. So in the case of this person with multiple 401k plans, what you might consider is taking one of those old 401ks and rolling it to a Roth IRA. So what will happen there is you would want to make sure that you don't do any tax withholding. The best thing to do with Roth conversions is not to do tax withholding. Just pay that tax out of pocket when it comes time for taxes. But roll that money from the 401k to a Roth IRA. It would be taxable in the current tax year to you. Let's just say that's $100,000. Then that $100,000 is going to be added to your taxable income for this year. The advantage of doing that is that the money will grow tax-free from that point forward. Now, there is a 5-year rule in this person's case where you have to leave the money in the Roth account for at least 5 years in order to get that tax-free benefit. But if you're looking to diversify your taxes as your tax buckets, as Adam mentioned before, that may be a really great way to do that. So we help people with those kind of things all the time, and they could be 35 years old or they could be 65, but they're trying to figure out what's best for them and what do they think tax rates are going to be in the future for their personal situation. So that's a really great question.
And we're coming up on an opportune time in that it's near the end of a calendar year. So, sometimes people like to spread that out over 2 tax years. And so maybe you do part in December, part in January. You're still doing it roughly around the same time, but you're spreading that impact over 2 different tax years. That could be a neat strategy as well.
Yeah, and this is a great strategy, but it's one where I want to be sure that people know that they should bring in their advisor or their CPA, somebody, because you can get in some trouble with these, right? If you have multiple IRAs, then there are some rules against that. You just want to keep this really clean. It's kind of easy to make a simple mistake when doing these. So they are a great tool. As Chad said, we use this idea and this concept frequently with clients, but just be sure you are utilizing somebody who works in this space or again, in the accounting space to help you with that. And jumping into the Roth versus traditional debate, and this is where we start to talk to our clients, or the employees of our clients within 401k and retirement plans about which one makes more sense for them, right? And first we have to make sure they understand what a Roth is versus what traditional is. And for anybody on the call who might wonder the same thing, I'll give you a very simple example. If you make $50,000 in a year and you put $5,000 into a traditional 401k, come tax time, you made $45,000 that year, right? So you're basically hiding $5,000 that's going to grow tax deferred and then in retirement be taxed. Same situation, $50,000 a year, $5,000 goes into a Roth 401k. Come tax time, you made your full $50,000. So that is after tax money, and that money is going to grow tax-free over time. So again, I mentioned this earlier, I'm a big proponent of Roth. I just love the idea of tax-free growth over time. And I've seen the emotional side working with retirees of seeing this pot of money, but knowing that some percentage, 20, 25, whatever it might be, belongs to the government. So again, for those reasons, I've always pushed towards Roth when it makes sense. But if you are in a situation where you're trying to figure out what really makes most sense for you, and you've got tax situations that maybe are a little bit more complex, at that point you need to bring in the accountant, the CPA, and your advisor as well. Bring everybody together and just see what makes the most sense, and be sure we're doing what's right for you. Because sometimes that advantage year over year might outweigh the advantages of Roth. Guys, anything to add there?
No, great points.
Cool. And this is a chart. If you want this, then by all means, we can give it to you. This basically just breaks down what we just talked about and the differences between the two. Some people have a better time with a visual like this. So this is something that we present to the employees we're working with and try to help them understand the differences between these two.
I think one good point from this chart is that any money the company puts in on your behalf will be traditional and pre-tax. So it all goes back to that tax diversification that even if you do 100% of Roth funds yourself, you're still going to have that pre-tax money from your employer, and so it just gives you different buckets to pull from in retirement.
Yep. Go ahead, Zach. Sorry.
No, you're fine. Go ahead, Chad.
I was going to say another point we make with employees when we're doing enrollment meetings or group meetings where there is a Roth option, we on a general basis recommend that folks that are have longer than 15 years till retirement stick with Roth, and if you're 15 years from retirement or less, consider pre-tax. Now that's kind of just a very general advice, but it's kind of a good way to frame up. You should, if you're 25 years old, you should definitely be doing Roth. There's no question. But
sorry.
When you get to that point where maybe you're 15 or 10 years from retirement, it may take a little bit more of a conversation and figuring out, okay, what really is best for me. But think about it this way. I mean, the longer you have to invest, the more Roth makes sense. I mean, it's a no-brainer if you're 25, 30, 35 years old, 40 even, I would say. It really is a great vehicle.
And one more piece on this, Chad, do you want to jump in on some different options to defer that employees have?
Yeah, so I like this. I like this order of operations. So if you said, okay, what are the priorities? If I want to save for retirement, what are the things I should be thinking about? We recommend saving at least 10 to 15% for retirement. So the first place to look is if your employer has a 401k match, do that amount, get the most match that you can possibly get. So let's just say that your employer has a 50% of 6% match. I would say at the minimum do 6%. You're going to get that 3% match from the company. At that point, that's a total of 9%. We'll talk about this more in a minute, but you may, if you have access to an HSA, that may be your next place to go. The benefits of an HSA, just very briefly, are that the money goes in pre-tax and it grows tax-free, and then distributions come out tax-free, as long as they're used for qualified medical expenses, things like that. So that would be your next bucket, as long as you aren't planning to use your HSA. Some people use their HSA every year, but if you're looking at it from a retirement vehicle, that's the next place to go. Then I would go back to the 401k plan and max that out at 19.5. After that, you could look to an IRA. If you, as we mentioned before, IRAs do have income limits. So if you make too much money, you may not be able to contribute to a pre-tax IRA as well as a Roth IRA. There's a different limit for that. However, you still might be able to do what's called a backdoor Roth. I don't think we're going to be able to get into all the details of a backdoor Roth today, but that is another option. And then once you've exceeded all of these or maxed out all these buckets, then you can look to taxable accounts or after-tax accounts, investment management accounts, or what we call them at the trust company. And these are subject to capital gains tax, interest income tax, dividend income tax. So they're not as tax friendly, I would say, as these other buckets of money. Adam, would you add anything to any of that?
Oh, definitely. But I mean, it's still a great way to get a return on your investment rather than, let it sit idle. So a lot of times we work with clients, they maximize each of these and then they want to put as much into taxable accounts as they can because it's money they're not going to use for the next few years. And, it's a great way to get return on it.
Yeah. One thing that's not on this page that is worth mentioning is that tax deferred annuities are another vehicle where you can put money into annuity and all of the growth is tax deferred, and if at some point in the future you take money out of that annuity, you'll pay income tax on the growth portion only. Word of caution there: annuities can be very complex, they can be very expensive, so you need to make sure you're working with a fiduciary to analyze if that's a good option for you. They're not the right thing for most people, but they can be a very effective tool for some people.
Chad, starting on the most important part of this page is that max employer match. Typically when we go into these meetings and there is a match in place, we're going to say they'll match up to whatever it is, and whatever the employee has to put in to get that match is where they go, right? And that might just be 6% total when you factor in their 3% and the company's 3%.
Yeah.
And then we're sitting there talking to them about the importance of saving 10 to 15%, and it's really hard to get them off just that minimum number they have to do. So I think I've heard you say recently that a lot of companies are starting to explore a stretch match. Do you want to talk to us a little bit about that?
Yeah, and I think when we take on new retirement plan clients, that's one of the things that we address right up front is, hey, let's talk about your match, and maybe this is a great opportunity to restructure it. So let's just say you had 100% of 3% match currently. It's a great benefit. So what are most employees going to do? They're going to put in 3% to get that 3% match. You could very easily change that formula to a 50% of 6% match, same cost to the employer, but you're asking the employee to put in 6% to get to 3%. So instead of them putting in 3, getting 3, that gets them to 6 total, they're putting in 6, they're getting 3, that gets them to 9% total, closer to that 10%, 15% savings rate that we recommend. So I've even seen some companies do stretch matches up to 10 or 12% to really get their employees to, and I think we're going to continue to see that trend into the future.
Yeah. Anybody who changes theirs to 10 to 12%, let your employees know that was Chad Schollart's idea.
It's an interesting point, Zach. I think sometimes we assume that that's going to be perceived as a negative to employees. And when we explain a change like that, that can potentially be a negative, I think one of the key points is, look, we've talked with the employer. We really want to help employees save for retirement. We want to make sure that they can retire with dignity and confidence. And this is one way we're trying to help you save more and put you on a better path to financial success. And 99 times out of 100, it's received pretty well. Not always, but it's typically folks understand they need to save more for retirement. They agree with that.
Yep, good point. So we mentioned earlier Roth conversions and how they can be a great idea and great concept for some people. Sometimes they're not always the right fit. So here are some things to consider, and I'm glad we're touching on this based on the question we got from the audience. Really 4 keys to this. Number 1 is, what will your tax rate be in retirement? For most of us, that's purely a guess, right? And that's just going to be our guess, our gut feel, whatever it is, and we're going to have to really go off of that in terms of how we feel about making this decision. Other people maybe could predict that a little bit more. Maybe you've got an income that isn't that high, but you've got a great pension coming down the road, plus Social Security, and maybe you have rental income as well. And so you just have a general sense that you're going to be in a higher income situation in retirement. in which case this could make a lot of sense for you to do the conversion now at your lower rate, as opposed to waiting till retirement. The second is your time horizon. So the longer your time horizon, the more time you have to recoup the taxes you pay on a conversion. So if you're 70 years old and you're thinking about doing a big conversion, maybe you don't have quite as much time to make up that big gap from that 30% or whatever you had to pay on taxes. And to that point, number 3 is available funds outside of your retirement account. So almost always, now maybe not so much for younger people, but almost always we're telling people, if you're going to do a conversion, pay the tax piece with cash you already have on the side. Don't take that hit on your retirement account, because to point number 2, it takes that much longer to make up that big loss you just suffered through taxes because you paid it out of that account. And the last thing is a relatively high income beneficiary. Chad, I think you hit on this a little bit earlier. So if you've got, this goes back to that 10-year rule with an IRA. So you pass and your son and daughter inherit your IRA. A traditional, they each have to take it out within a 10-year period. And by the way, I don't know if we covered this, that could be spread out over time. That could all come out at once. There are no rules around that. But if you've got a really high income earner in that next generation, then they're going to be stuck with a pretty significant tax bill. So if you care more about protecting them and you're willing to take the tax hit on your side to be sure they don't have to do so down the road, this could be a really good strategy for you.
Yeah, I've got a client. Actually, I've got a client that we've been working through that very topic, because he and his wife have saved a tremendous amount for retirement. They live very frugally, and their income in retirement is going to be very, very low. So they're probably going to be in the 12-15% tax bracket, depending on whether it's now or after 2026. But they have a son who works for a hedge fund in New York City. His income is extremely high. And then their daughter also, can't remember her profession, but also very high earner. So what they're thinking about is converting some money to Roth in order to pass along to them at their death, and knowing that their tax rate is going to be far lower than their kids' tax rate when they inherit this money. So they're really giving something really pretty cool to their kids that's going to be a tax-free benefit to them.
Yeah, and looking at it across the family, it's a big savings, as you just mentioned. But of course, we have other clients who say, "Nah, let them pay it." It's whatever you prefer.
Right.
And just maybe a better visual on this of whether you should do a Roth conversion, some things to think about. Again, it's the tax rates in the future, providing funds to your heirs, and how you want to do that. Are you okay to pay the taxes now? And is your AGI, your tax increase, going to be tolerable for you? Which leads us to the point of consult your CPA, right? Bring in that financial professional you have and that tax professional and really think through that. And typically it's not just a one-time thing, right? Somebody's got a sizable IRA and they say, I just want to convert the whole thing. There's usually a lot more strategy behind it. And that becomes a conversation with the advisor and the CPA of, what if we spread this out over 7 years, right? And kind of minimize the tax burden that way. So oftentimes, guys, it's going to go that way more than just a lump sum.
Yeah, I think, Adam, you had somebody that you were working with earlier this year who was extremely concerned about higher tax rates in the future, and they were going to convert $1 million or $2 million to Roth and go ahead and take the tax hit. I don't remember if they actually pulled the trigger on that or not, but we are seeing some people that are converting some very high dollar amounts. But I think you're right, Zach, spreading it out over multiple tax years can make a lot of sense. And I've even had some folks that I work with that have retired. They're in a very low tax bracket now, and they're doing some Roth conversions over the next several years, just because they're trying to take advantage of those low tax rates, and they're willing to pay up to 25% in taxes, or 24%, excuse me, in the 24% rate, just because their assumption is it's going to go up in the future. So they want to try to get as much of that knocked out in the next few years as possible.
Definitely. And, I think one of the neat things is that part of our financial planning process can include some modeling as to, what's best for your situation. And so our software already has those sunsetting tax laws built in. And then we can also look at, what if you did a Roth conversion? What would that look like? What if you didn't do a Roth conversion and kept things? Is there any tax benefit to you? And so when we work with our clients, we go through all of those features because there's, of course, the mathematical answer and, what makes the most sense just in terms of numbers, but then also what are your goals, what are your priorities, and what are you most comfortable with, and figuring out, would you rather have your beneficiaries receiving that money tax-free? Would you rather pay the taxes? Look at all of those factors together.
You guys, let's wrap up with a couple more quick ones. Chad, if you want to walk us through a couple other tax strategies that we haven't hit on yet.
Yeah, so real quick, we talked about health savings accounts already. If you're eligible to contribute to an HSA, they do have a triple tax benefit. They're the only vehicle that has this. Pre-tax contributions going in, they grow tax-free, distributions come out tax-free, as long as they're used for medical expenses, qualified medical expenses. So this is something that you would consider, as I said before, if you're going to use it as a tax benefit, and you would want this money to be invested. We recommend that it be invested pretty aggressively because of the tax-free growth component. But you can contribute $7,000 a year for a family. So that could be real money that you sock away each year and build up in the form of tax-free growth, similar to a Roth. And then the other one is qualified charitable distributions. So if you are 70 and a half, Adam, correct me if I'm wrong here, 70 and a half, you are able to make donations directly from your IRA. This is not available for 401k accounts, directly from your IRA to a charitable organization. And that instead of getting a tax deduction, that money, reduces your taxable income. So this is something we've seen much more of because of the standard deduction being so high right now. So some people who typically in the past may have contributed to a charity and gotten a deduction for that, because the standard deduction is so high, they're not really getting the benefit of that anymore. So this is a way, we see this a lot with people who are taking, they're required to take minimum distributions from IRAs. And what a lot of them are doing is saying, okay, a portion of their required distribution, they're sending to charity, and a portion they're taking as taxable income. So it's a pretty cool strategy, and it's definitely something you want to work with a professional on to get all the details correct.
Yeah, and just a note on that, that was not a verbal typo. It is still 70 and a half. So remember, the RMD age has changed to 72, but you have to be 70 and a half still to qualify for the charitable distribution. The reason they did that is to confuse us because they find it funny. There's no logical reasoning behind it. Adam, wrap us up with some tax efficient investment options.
Yeah, so as you look at different types of investments, we find that some are more tax efficient than others. So if you start at the very top here, the most efficient, muni bonds, that's going to be exempt from federal income tax and could even be exempt from state income tax. As you go further down, you have equities, and those are generally going to offer dividends and capital gains, which are taxed at their own rates, all the way up to bonds and high yield, which are taxed at ordinary income rates. So some of the things that we'll work with our clients is, what is the best account for the best type of tax benefit that you get. So maybe we'll have equities or higher growing assets in Roth accounts because we know that money is going to grow tax-free. And then maybe in taxable accounts, you'll keep some of your muni bonds or other low tax investments. And so you might want a 60-40 overall portfolio, 60 stocks, 40 bonds, but your Roths might be 100% stocks and your taxable accounts might be 100% bonds. And so you can manage that asset allocation, that 60/40, across different types of accounts to create the most tax efficient environment.
All right, I think we covered all questions as we went, so thanks for taking care of those guys. And you will see, oh, looks like we're taking December off because Adam decided to decorate too early. So we are going to skip December, take the holidays off. We will be back in January with the new slate of topics for Retirement Plan Academy. We do want to hear from you, as you see on this page. So part of the exit questions here, which again, for CE credit, please answer all those. We do have to send these off. But we want to hear what kind of topics you'd like for us to cover. And we'll certainly take any suggestions you have and run with those and put something together and cover what's on your mind. So, gentlemen, Adam, Chad, thanks for joining, and to everybody on the call, thanks for joining us. Appreciate you all joining with so many of these this year, and let's do it again in January. Take care.
Happy holidays, everyone.